Professor Karn with you today to go over some merchandising journal entries for perpetual inventory systems. We have 4 different problems to look at. We also will take a look at the multi-step income statement. Notice that we have 4 different problems that we will tab through down here at the bottom of the spreadsheet here. Okay, so let's look at this first one. We're going to deal with Hartford Jewelers. And they had the following purchase transactions. Journalize all necessary transactions. Explanations are not required. Okay, so on the first one, on the first 6/20, it looks like we have 2 different journal entries to do on that date. It says that Hartford purchased inventory of $5,400 on account from Surrey Diamonds, a jewelry importer. Terms were $315 net 45 FOB shipping point. Remember, Hartford will pay within 15 days, they will receive it 3% discount on this. Otherwise, the full amount was due within 45 days. And in this case, Hartford, because it's FOB shipping point, must pay the shipping as the buyer. Okay, so let's take a look at this. Think about what's coming in. What are we buying? We're buying merchandise inventory. That's an asset, so we will debit that. And notice, because we owe this and there were terms, we're the buyer, we owe it, we have to pay it back, we will credit accounts payable. And again, they told us on account, so we would also note from that particular information that it was accounts payable as well. On the second 6/20, we kind of have to think about this for a moment. It says we paid freight charges of $300. Now, in some cases, if you think about it, we saw an account called freight out expense or delivery expense in the lecture video, but that doesn't apply here because this is on freight that we're paying freight on what we purchased. So here's where you have to be careful. What we have to do anytime the cost basis of inventory is going to change, we have to make sure we appropriately account for that. So when you think about it, the freight or shipping charges is going to cost us more money as far as our cost basis of inventory. So when we go to sell it, so say that we sold this $5,400 of inventory for $10,000. Well, it's really not only it didn't really cost us just $5,400. It actually cost us $5,700 because the freight charges are going to increase the amount that our inventory cost us. So we will have to again debit merchandise inventory here for $300, and then it says that we paid it, so we will credit cash. So make sure anytime we pay freight charges in a perpetual inventory setting on inventory that we buy to resell, we will always debit and increase the cost basis of merchandise inventory. Okay, then it says on July 4th, we returned $900 of inventory to Surrey. So in that case, we basically just have to flip a portion of the first journal entry. So we will debit accounts payable and reduce it for the amount of the return, and we will credit and send back the merchandise inventory. Okay, then we get to a point where we have to pay Surrey Diamonds less the return. Now notice in this particular example, the Hartford Jewelers did not take advantage of a discount that they were offered. Now, if they would have taken advantage of the discount, you'd have to make sure you took off the amount of the return first. So you can't get a discount on something that you return, just so you're aware of that. So on 7/14, think about this. We bought $5,400, we returned $900, so we still owe $4,500, and that's the amount of accounts payable that we have to debit and pay off. I'll put the calculation in here for you so you can see $5,400 minus the $900. And that comes out to be $4,500. And then we're going to pay it off, so we're going to credit cash. The journal entry would have been a little different if we would have taken advantage of the discount here. So just kind of keep that in mind. I think we will see one of those coming up here shortly and how that works. Okay, so then we get to the 16th of July, so we'll put that here. And it tells us that we purchased inventory of $3,800 on account from Swift Diamonds, a jewelry importer. Terms were 3/10 net end of month, FOB destination. Okay, so in this case, we have a 3% discount if we pay within 10 days. Otherwise, the full amount is due at the end of the month. And in this case, because it's FOB destination, the seller is paying for the shipping charges. So we won't have to worry about them here. Okay, so on this, we're going to debit our merchandise inventory. And that was for $3,800. And we have to credit accounts payable because we owe it. Just a note here too, something that you may be asked to do in the My Accounting Lab, you may have to put the company name after the accounts payable. The book may ask you to do that in the My Accounting Lab format. Okay, so then on the 18th it says we received an $800 allowance from Swift for damaged but usable goods. Okay, so anytime that someone grants an allowance, basically what we're doing there is we're going to reduce the amount we are owed or get a refund of cash, either one, and then we're going to be able to credit inventory, but we don't have to send it back. It's just going to lower the cost basis of it. Okay, so let's see how we would do that. So 7/18, we would debit in this case accounts payable because we're reducing the amount that we owe, 800. And then even though we're not sending it back, the cost basis of our inventory is going to be decreased, and we'll be able to still keep these goods and use them. Okay, then we get to the last one, which is the 24th. Oops, escape. So it looks like I changed that there. Okay, so let's go to 7/24 here. Okay, we paid Swift Diamonds less the allowance and the discount. Okay, so the thing that we have to do here is be a little careful, okay, how we handle this. So we know accounts payable is being paid off, and we know that it's always going to be paid off in full, whether we get a discount or not. So let's see, we have 3,800 was the full amount, minus the allowance of 800. So we know that in this case it's going to be paid off for 3,000. Now we know we have to credit cash, okay, and we know we have to credit something else. Now here's where I really have to caution you as you're learning this material. Anytime we are a buyer of inventory and we receive a discount on something that we purchase, make sure you don't use sales discounts here. It is not a sales discount. We did not sell it in this case, we purchased it, okay? And remember, sales discounts doesn't have a credit balance, it would have a debit balance, so it would not, a sales discount would not apply here. So what we have to realize again is, what are we doing? We're lowering the cost basis of our inventory, and that's a good thing for Hartford Jewelers. We want to pay the least amount of money for the inventory to resell as possible, because that allows us to generate more revenue when we go to sell it. So anytime you have a discount on inventory that you purchase in a perpetual setting, you will have to credit merchandise inventory for the amount of the discount. Now, let's calculate the discount. We know in this case, I'm going to make this a little bit larger here so we can fit it in. Okay, so we know that the amount is 3,000. Again, you do not get a discount on any allowance or any return that you get, and the amount of the discount was 3%. So we take it times 3%. So that would come out to be $90. Now, how much cash do we have to give them? Well, very simple. All we would do here now is take the 3,000 that we paid off in full and subtract out the $90 discount, so we have to send them $2,910 of cash. So what you want to do here is realize that even though your account is paid in full, you only had to give them $2,910 of cash, not $3,000, because you received a $90 discount on the inventory you purchased. Okay, I'm going to pause the video here a few minutes and let you kind of look at this, and then what I'll do here is come back and we'll take the opposite look of the opposite perspective and look at sales transactions. Okay, I'm back with you now to go over the perpetual sales transactions. We have journalized the following sales transactions for Austin Mall. Explanations are not required. Okay, it says that on January 4th that we sold $10,000 of antiques on account. Credit terms were $115, net $30. Cost of goods is $5,000. Okay, recall back to the lecture video that, again, anytime we have a sale, we have two journal entries to record. We have to record the sale, and then we have to record the reduction of inventory and increase of our expense because we sold the items. Okay, so always record the sale first. So in this case, we sold these antiques on account, so we are owed the money, so it would be a debit to accounts receivable, and that would be for $10,000, and we would credit our sales revenue for the same amount. Now that records our sale. Okay, now obviously you can see they have another amount that they gave to us that they would have to share, and that's our cost of goods sold. So remember, that is our biggest expense account for a merchandising company typically. So we would debit cost of goods sold in the second journal entry, our expense account. And that was for $5,000. And let's think about this. What did we sell? What's leaving the business? We are giving up merchandise inventory. So you can see here how this makes sense. We bought goods for $5,000 and in turn doubled our money because we ended up selling them for $10,000. Now remember, these are on credit, so they have the opportunity, the buyer does, of getting a sales discount. We'll see if they pay within a 15-day period or not. Okay, then we get to the 8th, which is the received a $300 sales return on damaged goods from the customer. Cost of goods damaged is $150. Okay, in this case, we'll also have two journal entries to do. One to record the actual return, and then to from the buyer, and the other to record the inventory coming back in. Okay, so in this case, we will have to use our contra revenue account, sales, returns, and allowances, and that's for $300. And we have to credit and reduce the amount that they owe to us, accounts receivable. Okay, in the second journal entry, we have inventory coming back in that's damaged. We still have to take it back and record it coming back in. Merchandise inventory is coming back to us, so we would debit that for the $150. And technically, we really didn't sell this amount of inventory, so we have to credit and reduce cost of goods sold because we didn't have this expense because it's been returned. Now, some people ask me what happens to the damaged inventory. Well, we'd have to figure out how we would handle that. Is that an insurance claim in shipping, or is it something we return to the manufacturer that we bought it from, so forth and so on. Okay, then on the 13th, it says that we received payment from the customer on the amount due from January 4th, less the return and the discount. So on 1/13, we know that we're getting payment, so we know cash is coming in, so we'll look at that. Now, we know this is the 13th, so we know if we go back to the 4th, we know they paid within 15 days, so we know that they will get a sales discount, so we have to debit that because this is on something that we sold. And we know that for sure that they're paying their account off in full, so let's do that first. We know that that calculation would be the 10,000 minus the $300 return of damaged goods. So we know that technically they are paying off their account of $9,700 in full. Now, how much is the sales discount? Well, very simple transaction now. We know how much they owe us, so it would be $9,700. Put the dollar sign there to make sure we're consistent here. There we go. So we know $9,700 times 1%. And that comes out to be $97. And now how much cash are we going to receive? Simply take your $9,700 minus your $97, and we know that we're going to get cash in the amount of $96.03 to us. So they took advantage of the discount, so we get less cash, and they're still paying off their full balance that they owe us of $9,700. Okay, then we go to the 20th of January. Sold 5,200 of antiques on account. Credit terms are 110, net 45, FOB destination. Cost of goods sold is 2,600. Okay, so in this case we are offering a discount, and in this case it's FOB destination. So because of that, we are going to be, as when you think of Austin Mall, we being Austin Mall, we're going to have to pay the shipping charges. Okay, but we have two journal entries to record the sale and the reduction of inventory. So let's go ahead and do that first. We know we have to debit accounts receivable for the full amount of $5,200 and credit our sales revenue of $5,200. The second journal entry, we have to record our cost of goods sold and our inventory going out. So let's come down here. There we go. All right, so we have cost of goods sold. And that was for $2,600. And we would reduce our inventory account by that same amount. Okay. Also on the 20th, we have to address the freight. Okay, it says Austin Mall paid $120 on freight out. Okay, in this case, we will either use one or two accounts. Let's go with what the book uses. That would be delivery expense would be our debit. I'm going to also put or freight out expense would be fine. Let me make this a little bit larger for us here. To that. There we go. Sorry about that. Okay, so let's see what we have here. So you could use either one of these accounts. It would be perfectly fine to do that. I'd recommend probably going with delivery expense because that's what my accounting lab, I believe, uses. So that's why I put that one first. And it says we paid it, so we would just credit our cash for $120. Okay, so let's see what we have here. The next one, it says here on the 25th, Austin Mall negotiated a $500 allowance on the goods sold on January 20th. Okay, now remember, an allowance is different because the inventory is not coming back to us. So we're just going to have to reduce the amount that they owe to us, and we're not getting the goods back. So only one journal entry would be necessary here. So we would debit our sales, returns, and allowances contra asset account, contra revenue account, and that's for $500. And we would just credit and reduce the amount that they owe to us, accounts receivable for $500. So again, sales, returns, and allowances is a contra revenue account. We debit that, and we credit the amount that they owe and reduce that. Again, no second entry here because of the fact they're not sending the goods back to us. All right, then the last one here states that we received payment. Let's move this over a little bit so we can see what we're looking at here. Received payment from the customer on the amount due from January 20th, less the allowance and the discount. Okay, so very simple transaction here. Again, we're going to receive in cash, so we know that we're going to debit that. They know that there is going to be a sales discount that they took advantage of. They had, if you look at this here, they had 10 days to pay on the 20th, and it's only the 29th, so we know that they get the 1% discount. And we know that they're paying what they owe to us in full. Okay, so let's see what they owe to us. So we know that it's $5,200 minus the $500 allowance. And we know that they owe us $4,700. And then we take the sales discount of 1% on that amount. So we have $4,700 times the 1% discount, and that is $47. And then to get the amount of cash we receive, we simply take the $4,700 minus the $47, so we know it's $46.53 that we're being paid in cash. Okay, so we've seen both the ways that you would account for purchase transactions in a perpetual setting, how to account for sales transactions in a perpetual setting. The next thing we'll take a quick look at is how to do closing entries in a perpetual setting. I'll pause the video here for a little bit and get to that then. Okay, now let's take a look at perpetual closing entries here for a merchandising business. And we have the adjusted trial balance of business reduction systems at 3/31 of 16. And we have all of our accounts here listed, as you can see. So you can see this whole adjusted trial balance here. And we have to do our closing entries as a result. Okay, so remember we close out revenues, expenses, income summary, and withdrawals. And remember, if we have other revenues, we have to include them. And we have several different expenses as well as contra revenues to include in the second step. So it looks like we only have one revenue account, so we'll close that out by debiting it, so it's sales revenue. And that debit amount was $234,000. And remember, we credit our temporary account, income summary, same exact format as before, for the total amount of all revenues. So again, the only difference here is we're not closing out service revenue, we're closing out sales revenue because we have a merchandising business. Okay, now the second journal entry is a little tricky because we have some new things to include. Let's go ahead and debit our temporary account. We know we have to debit the income summary for the total amount of everything. We'll leave that blank for now and we'll come back and put the total in. Let's do all of the regular expenses first. So we see that we have selling expenses. We see we have administrative expense. And we see that we have interest expense as all accounts that need to be closed out expense-wise. Now, here are the new accounts we have to not forget. Remember, cost of goods sold is an expense. That must be also closed out, even though it doesn't have the word expense in it. We know that our two contra revenues, if we have them, must be closed out, and we have them both. We have sales, returns, and allowances. And we also have sales discounts. Okay, so let's go ahead and put our numbers in here as our credits that we closed out. So we know we had $27,600 for the selling expense. Administrative was $14,600, and interest expense was $2,000. Our cost of goods sold was $93,600. Our sales, returns, and allowances was $1,500, and then finally sales discounts was $1,900. So let's just quickly add those up. Don't put. I'm gonna erase. I'm just gonna get a total here real quick. and we see that it comes out to be $141,200 will be the amount that we have to debit to income summary. Okay, so that concludes the second journal entry where we had to close out our revenue, or excuse me, our expenses, as well as our contra revenue accounts. Now we just proceed as normal. We close out our income summary. Notice that our revenues are greater than our expenses, so we know we'll have to debit income summary for the amount, and we know that we're going to have a net income, so we'll transfer that to Boxer Capital. So let's do this here. We know that 234 minus 141,200 that comes out to be $92,800 what we have to transfer in net income to the capital account. Let's move this over just a bit and fit this in there so that's not over top there. There we go. Alright, I can bring this back. Okay, now the other thing we have to do is close out our withdrawals just like we did before. So we debit and reduce capital, and that was the amount of $40,000 of withdrawals, and we credit that and close that out. Okay, so there you go. There's the nice example for you of how to close out the accounts in a perpetual inventory system for a merchandising business when you get to step 7A of the accounting cycle. The next problem we'll take a look at is looking how to do a multi-step income statement and how that differs from the single-step income statement. Okay, now we're going to take a look at the multi-step income statement and how that works. And we'll also compare that to the single-step income statement. We're going to use the same data as we did for the closing entry problem we just did. So we have the business reduction systems adjusted trial balance again, just like we had before. Okay, so let's see how this works. Again, it'll be the proper heading, the business name. In this case, we're preparing a multi-step income statement, and it's for the year ended March 31st of 16. Okay, so the way that we would do this, approach this, we would start off with our sales revenue. And in this case, we have to look at sales revenue as a whole and then get to net sales revenue, because remember we have contra accounts that we have to deal with. So we have $234,000 of sales revenue. We will subtract out our sales discounts and our sales returns and allowances. Okay, let's take this off. That's not bolted there. Okay. Bring that back there to line up. Okay, so now we will subtract these two things, 1,900. Subtract out 1,500 here, and we would total this up. So we know that our net sales revenue comes out to be $230,600. Okay, so there's the first step of our multi-step income statement, finding net sales. Again, the way we do that again is to take our sales revenue, subtract our two contra revenue accounts, and to get net sales. Okay, the next thing we want to do is calculate what's called gross profit, and that is how much sales revenue did we generate minus the amount of our product cost or cost of goods sold. So in this case, then we would subtract immediately cost of goods sold. So we have 93,000. Let's move this down a little bit so we can see our data here. There we go. 93,600. and that yields to us our gross profit. Now, you may also see this referred to as gross margin, so I will put that in parentheses. Either of those terms are correct. My accounting lab specifically uses gross profit, so I'd probably stick with that, but you may see both. So now we get 137 even here. So I will put a line there to signify that we subtracted that out. Okay. Then we get to our operating expenses, and we would break them down into the two categories that I talked about in the lecture video. We have both selling. They give us the total amount, so selling expense. And that was $27,600. And our administrative expense of $14,600. So our total operating expenses come out to be $42,200. Put a total line here to signify we're adding that up to get that amount there. Now, here's where you deviate a little bit from what we saw in the first part of the course. We did an income statement for a service-based business. Well, we just kind of went through it and got our net income or net loss pretty straightforward here. We didn't have to deal with any of this, product costs or anything of that nature. And really what you have to realize here is that what we're talking about when we subtract we take the $42,200 of operating expense minus, if we take that from the gross profit of 137, we get what's called operating income. Now that means that we are looking at what is a business, our business is selling a product to generate profit. How do we do doing that overall, including our product cost, including all of our operating expenses, selling expenses, things that directly relate to selling the product, and then administrative things that are extraneous to things of supplies expense, or could have property tax expense, things of that nature. So we see that once we do this here, we have operating income of $94,800, and we have a line. We'll draw a line there. Okay, now when we think about, we could have other sources of revenue or other expenses that we incurred outside our primary goal of selling a product for a profit. So we may have an other revenues and expense section. Okay, and in this case we can see that we have interest expense, and that is $2,000. Now, because it's an expense, they want you to put that here in parentheses because we will subtract that. So we have total revenues, other revenues, and expenses, and that would be 2,000. And we'll put that in parentheses. Come back here. Now, if there was interest revenue here, you would have to put that as a normal. You'd add that back in and not subtract it. Some problems have both interest expense and interest revenue. Again, this is falling outside the scope of your primary goal of operations, which would be to sell a product for a profit. Okay, now once we figure this out, we get our net income, and we see that it would be $92,800 as our final answer, and that's what we got. If you look back, let's do this here. We did see that here. I'm going to put this in green. Okay, notice that on our closing entry problem, that was exactly what we got. Our net income was $92,800. So we proved that this solution to our closing entries was correct. Okay, now let's look and see what the single step income statement is. I've already completed that for you so you can see the differences, and I'll leave it on the solution to the problem. Notice that the single step income statement is much shorter and doesn't really glean as much information as we can from the multi-step. Notice you'll still get the same answer of net income of $92,800. Basically, you start with the net sales revenue. That calculation is done outside of this document, and to subtract all the expenses. That's it. So you can see how you would take out your COGS, your selling, your administrative, and your interest to get total expenses of $137,800. You subtract that from net sales revenue of $230,600, and that's what you get, the $92,800 there. So you can see that we get multiple things of information up here. You get your net sales calculation, you get your gross profit, and you get your operating income, and then your net income. So a little different format here, so I would recommend for all of these problems to practice them and see how you do. If you have any questions, please let me know.